sitting here today with a wealth of knowledge, and we're here today discussing SBA and all things that you either may or may not know, and things that you may hopefully come to learn that will help you in your decision making, right? In terms of what programs may be best for your business. Sitting today with Kurt from TMC Financing, and he's one of our senior executives, and I wanted to have him kind of come into the hub, if you will, so that we can kind of pull the veils off some things, demystify are the terms you kind of hear often, but I wanted us to have some straight talk, right? Because I know a lot of people have some apprehension or maybe even confuse some of the SBA programs by the name, right? So I wanted to have Kurt here with me, and I also, before you even begin to kind of dive into the context of the conversation, I wanted to find out a little bit about you and, this passion world we live in business. What brought you into it, and what kind of drives you?
Yeah, good question. Well, great to meet you and very excited to spend some time with you today. Little background, I'm the Executive Vice President at TMC Financing. I've been with TMC for just over 11 years. Before that, I worked for a variety of banks. I worked at Wells Fargo, US Bank, a couple community banks, First Republic Bank. So I have a pretty good banking knowledge before I joined TMC Financing. I've always been really centered on the business banking, working with small businesses, and probably over the last 20 years, really dedicated to SBA lending. And SBA lending is a wide variety of lending options. And what our company does, our company is what's called a Certified Development Company, or CDC for short. And the CDC works on one particular loan program called SBA 504. So we can get into the details of that, and I can touch upon some of the other SBA programs, but I'm not an expert in the other SBA programs or SBA. SBA has a wide variety of ways it helps small businesses. Our company just does one particular product. It's a great product, but that's what TMC Financing is, and that's who I am.
Wonderful, and thank you for specifying that, because I at least for my audience, a lot of times we may get confusion because there's so many SBA programs that exist, right? And obviously two new ones that are in particular that I think are now getting more notoriety, right? But these programs that we're talking about, 504 specifically, have been around. Can you speak to, I don't necessarily want to say origins, but how 504 it started? Yes, or started or stands out on its own. Mm-hmm.
So the SBA 504 program started in the early 80s, and it was and it is a job creation program. So different types of SBA programs and services have different targets. The SBA 504 program is targeted to help businesses maintain their employees and more importantly, grow their employees and create jobs so that the communities have good paying jobs that support their families, and that way the whole country does better. So how do we create jobs with this program? The SBA 504 program is a combination of financing with 4 different partners. We have the small business applicant. We have a bank, Wells Fargo, B of A, community bank, any private bank or credit union. We have the CDC, which TMC is, and then we have the actual SBA. So I can get into the details of that later and how those all kind of function and work. But the idea of job creation is if a business is able to own their building, they're going to be a more successful business long term. They're going to not have to worry about landlord raising the rent. They're not going to have to worry about the landlord, evicting them and making them move to a different location. Especially important with some retail, restaurants, and other retail businesses. But it's important for all businesses to be able to control their own destiny, know what their payment's going to be, and have the security of being somewhere for long term. And the SBA feels, and it's been proven, that if a business does solidify its occupancy cost, it's going to be able to be a more successful business. It's going to have more cash on hand to hire more employees. It's going to be around for a longer period of time. So if we can get business owners to own their own building, it helps create and retain jobs.
Now, given this, this current landscape, especially social media, right? And we talk about a lot of online business, online sales, and, pivoting from brick and mortar. With all that information that's out there, there's still room for brick and mortar in a lot of areas. Can you speak to some of the businesses that benefit the most from owning their own building, right? And obviously, so, we know a lot of them collectively, but what are some of those industries that identify the best?
Well, our number one industry are professionals such as doctors, lawyers, accountants, dentists, medical professionals. Anyone in that professional office space is our number one category. However, probably our number one target is manufacturers, because manufacturers have a lot of jobs and they create jobs. So manufacturers, it gets a lot of attention in the United States because, again, because of the job creation and the job aspects of it. But it covers a wide variety of manufacturers. A big one out here where we are is food manufacturers. So, the guy that makes the sausage, the guy that makes the tortillas that you buy at Costco, or the cakes at Whole Foods. All of those, the manufacturing of that food needs space. So manufacturers, it could be just a widget too. It could just be, in Silicon Valley, they make a part for Tesla. So there's a lot of different manufacturers that benefit from owning their own business. Contractors buying a yard space, buying an old building where they have an office, but they just have plenty of room to store their trucks and equipment and inventory. So it really is amazing how many different types of businesses we are able to help. Online businesses, that's a growing segment, but those online businesses still need a warehouse. They need somewhere to store their stuff, and it's amazing how many businesses would benefit from owning their space.
Wonderful, and I couldn't have said it better. One of the absolute things that attracted me to the 504 opportunity as well. I see it all too often. Now, what I am noticing is that, because you always hear these unique scenarios. I'm sure if you're like me, you probably have heard all the scenarios in the world, right? And they're trying to figure out how to fit themselves into the program. What are some of the things you would think, or you would suggest, rather, if someone was preparing, right? If they were looking to do somewhat of a check off in terms of, does this program work for me? Or more importantly, do I have the criteria to qualify for the program? So I know a lot of hesitation comes in with the qualifications. However, there's an attractiveness with the way the program is designed for end user, right? It's like it was perfectly designed, like you said, for job creation and designed for the entrepreneur spirits in all accounts, at least the way I see it.
Yep, absolutely. So let me just touch upon the two biggest benefits of the program are a 10% down, 10% of the project. So the project is usually defined as just the purchase price, but you could add sometimes things to the purchase price, such as improvements or some equipment. But for the most part, the project amount is the purchase price. And the ability to finance 90% of that with only a 10% down payment from the client is probably the biggest single factor of why the program is successful. And then number two, the rates. We can get into the rates in a little more detail, but there are two loans, and the loan that is provided by the SBA is a fixed rate, 25 years, 25-year fixed rate, currently less than 3%. And those two factors, leveraging up 90% and getting a fixed rate for 25 years, less than 3%, are the two single biggest factors of why this program is super successful and why many business owners want it. Now I'm trying to remember your question though. I was going to have a point. What was your comment there?
Well, I think you hit it right there, and I don't even want to touch that. As a matter of fact, I want probably take a couple steps back and even because I think I mentioned earlier when talking about some of the confusion with some of the other SBA programs, and when talking with clients, they have some of this confusion too, right? Is there because I had this one, a direct question. A client asked, if I have EIDL, if I've done PPP, am I no longer, a candidate for 504?
Okay, yeah, and I think I remember now. You're kind of asking about the forms and am I going to be able to get qualified? So I can say first, there is a step to get pre-qualified. We have a variety of items that we would need. It shouldn't take an applicant more than 15-30 minutes to complete what's needed, as long as they're somewhat organized. If they're disorganized, it might take longer, but if they're somewhat organized, the pre-qualification process is pretty straightforward, and we can turn that answer around within probably about 2 business days once we receive the information. But to answer your question specifically about PPP and EIDL, no. If somebody has either of those 2 loan programs, that's no problem. We need to identify and we need to kind of factor in what those loan payments might be and how it could affect cash flow, but it doesn't disqualify an applicant in any way.
Perfect. And let's see here. I've also encountered questions where if someone has already an existing SBA that's not a PPP or EIDL, maybe they have a 7A and they want to refinance out, or they like the attractiveness of the 504, can they maneuver out of one of the SBA into a new SBA?
We now can. It's pretty exciting for us. We're super excited about the ability to now have the ability to refinance existing 7As and existing 504s into a new SBA 504 structure. There are some limits depending on how much is outstanding and how much would stay outstanding in either SBA 7A or 504. But for the vast majority of people, they don't hit those limits. And especially if you're refinancing from one to another, you're basically keeping the SBA balances about the same. So therefore you're not going to be increasing, and that should be fine too.
See. And those are and that's new, right?
Very new. Yep, very new. So we could have a segment on refinancing in general, because there's a wide variety of different ways to use the SBA 504 to refinance a variety of different types of loans. It's slowly over the last 5 years gotten easier and easier. The SBA has opened the door more and more to have the ability to refinance into an SBA 504. It used to be that the 504 is really just for purchase transactions, and especially now with the latest changes, the ability to refinance from an SBA 7A loan into a 504 it's a game changer. It's going to be really, really big for many businesses that are. Let me take a step back. The 7A program is a great program. It has a wide variety of business uses. Sometimes it's you're able to get approved with an SBA 7A loan where you might not be able to get approved with the SBA 504 loan program, and it gets the business owner the ability to buy that building. And so it is a great loan program, but oftentimes it's an adjustable rate loan and it's tied to prime. Rates are fairly low right now, but very likely everybody, prime rate is going to go up. And when those rates start to go up, the monthly payments are going to start to go up, and business owners are going to have to either charge more for their services or just make less money. And so if they can lock in with these low rates that we have now into a fixed product, it's going to be really beneficial to them, which we now can.
I'm glad you brought up rates, because I know sometimes you may have someone on one side of the coin on rates and someone on the other side of the coin on whether or not rates may either change or go in the opposite direction of what they're trending to. Is there a better time of the year or season, or is it, I guess maybe a better way of asking, does the timing matter in qualifying for SBA 504, or is it whenever the person meets those qualifications? Is it, because I know some people track or trend, look at the trending markets before they ever even approach. Do you recommend that strategy, or?
No, I would. I mean, the rates the rates do change. Our rate loosely tracks the 10-year treasury. So if you see the 10-year treasury rate going up or down, our rate is going to go, proportionally or thereabouts. But if I was a business owner, and even if the rate was 2 or 3% higher than it is now, that's not, to me, the important factor. And today is super low, so it is time to do it now. But it's really the ability to get into the building and get that building price set. Not as much as you want to maximize and get the lowest rate you can, but really the important thing is buying the building so you can stabilize your business and your occupancy costs.
Perfect. So now let's talk about, let's say, we're in the door. We know what we want to do as a client. We know we want 504. We're professional. We've already decided, okay, this is the program for us. So if we're now we're reaching out to TMC, and we're now wanting to go through the qualification process, what are some of the things that we can do to, I don't want to say increase our chances, but is there anything that looks better that, or what are some of those criteria that we can pay attention to, right? What are some of the things you would pay attention to if you were
if it's, let's say, if it's 6 to 9 months out, pay attention to your accounting, making sure that that your books are in order and that you have your accurate financial statements. If you use QuickBooks, make sure it's up to date with the sales and how the entry of the accounting is being done. And when you have your taxes done, you can legally put in a lot of expenses and therefore have less profit and not pay as much taxes. And a lot of business owners take advantage of really trying to not show profit so that they don't pay taxes. Again, legally, it's totally fine and okay to do. But the tax return is what we use in our financial review. And if somebody if somebody's showing more profit, then that is better profit or better cash flow for us. And we look at the last year's tax return most closely when we do our financial review. And if there's losses or if there's just no profit, it's harder for us to get that applicant approved. And so if somebody is one that kind of plays around with your tax returns in that way, you might want to consider talking to your accountant and making sure that there's some more profit in there so that you can get your loan approved.
Makes sense. So definitely paying high close attention. You hear that, guys, on your P&L and your taxes, right? How much you're actually bringing in and recording. You can record as many expenses as you want, but it may not be to your benefit.
Yeah,
I'm so glad you said that, because so many entrepreneurs, right, starting off, we know what we know, right, or we know enough to get by, right, but there's levels, and you're touching all the high points there, because there's a difference between qualifying for other programs and SBA, and based on what we're knowing or what we're understanding, SBA is the ideal. Because the alternatives may be hard money, right? And not to say that that's bad, but when you have an opportunity for 10%, I mean, you can't beat that as long as you prepare. So when we talk about preparation, is there anything you would want to speak to anyone who has an existing 504 as well? And maybe some of the things that they can do, like if they're maybe preparing for a refinance, or maybe they're outgrowing their existing loan as well. For those that are already in it, right? Anything that you would, because like I said, not often do we get a chance to get an actual expert who's actually processing.
I don't know if there's a whole lot more they can do to prepare. However, maybe you could review your loan documents and make sure that you understand when your rate might adjust, what it's tied to. Is this loan that I have now, a good loan long term, or is it something that I should look to refinance? Even loans that were done 5 or 6 years ago in the SBA 504 program, which is this great program, rates were higher 5 or 6 years ago, and the bank rate might even be higher than the SBA rate. So just a good comprehensive review of your loan and what your long-term goals are, I think is an important exercise to do, regardless of if you actually apply or not. But knowing what you have and the risks of the changes is important.
So what about when we talk about cash flow, right? Because we know, we can talk about credit, and I probably do want to ask you some questions about credit in general. But when we talk about cash flows, right? Because we know that matters a lot, how they've done it. Is it correspondent to what they're trying to buy? Is there a certain numeric number, or is it in perspective to the program itself, right? Because we know we have minimums. What's the SBA 504 minimum, right? And maybe what that cash flow needs to look like? Because would you suggest, if you can qualify for a smaller amount, to at least maybe begin that process? So
in our
system, if you will.
Yeah, in our pre-qualification is free. There's no charge, and we start with it's helpful to start with a number, and maybe it can kind of tie to back into what the rent is. So if somebody's paying $5,000 a month in rent, then that might be about $1 million purchase price or somewhere in that ballpark. So we start with a number of, hey, I'm looking at a building maybe around $1 million. And if we get into it and do the pre-qualification, we could either come back to them and say, oh yeah, you million, you might even get $1.5, maybe $2 million if you find a building in that range. Or we can come back to them and say, hey, look, $1 million, it's a bit of a stretch. You might be more in the $700,000 range, and maybe look for buildings, see if there's any fits in that range. So you don't get tied, you don't get locked into, just because you apply for $1 million doesn't mean you can't go up, and doesn't mean we can't go down. We just look at the ratios, and then it really is. It's not. FICO score is important, but unlike home lending or some other types of lending products, it's really individualized. We look at those tax returns. We look at your personal obligations and how it all relates, because it's unique for these business owners. They all have their own individual things going on.
Wonderful. No, that makes sense. And I guess I would also ask you a little bit about some of the area, right? Because you guys, TMC works specifically in the West Coast area. And obviously for, from a regional standpoint, there are certain businesses that you guys see often, right? Or maybe even certain industries that you specify in, because at least from my experience, right, we're a more of a platform that aids you, but you specify, right? Can you speak to CDCs that actually specify versus generalize, and the benefits of working with a company that specifies?
So to be specific, our company, our CDC, is able to lend in California, Arizona, and most all of Nevada. We can also follow our clients, so that if you're an existing client of TMC and you want to buy a building in Texas, we can finance that one. However, there are 200 CDCs across the country. We all have the exact same rates. We all have the exact same fees. We all pretty much go to the same credit committee, if you will, is the Sacramento Loan Processing Center, where these loans get decisioned by the SBA. So in general, we're uniform in many ways across the country. Different CDCs have different approaches about how they want to conduct their business. We take an approach, we want to help all businesses. We don't, and I'm sure every CDC wants to help all businesses, but some are limited. And if you're a smaller CDC, you have to pay attention to specific caps in an industry. There are many CDCs that are smaller, and they've kind of reached their cap on hospitality lending. So we could do loans for hotels and motels and things of that nature. But you can only have so much of your outstanding portfolio be in one particular industry. And many CDCs have kind of capped out. We can't do any more hotel loans because we have too many in our books. We're a big enough CDC where we've diversified enough, and we don't have those caps. So I think that's kind of along with the lines of your question.
No, that's perfect, exactly, and that's what I wanted my audience to know, that they that from a capacity standpoint, you guys can handle not only the volume, but you can handle the expertise, because you guys specify in the 504, of course, but you also specialize in that area. So there are common trends that you guys see often. So for all of my California, for all of my Nevada clients, please look out for TMC, because we're going to be sharing information with them. We're actually going to put together a kind of a mini guide to kind of help you prepare for reaching out as well. So those are some of the things we wanted to make sure that you guys knew. Kurt, is there anything that that you would want anyone who is on the fence, right? Maybe they're on the fence and they're trying to decide whether or not they're going to get started this year or next year. What would you say to that business owner?
I'd suggest to get pre-qualified. At least let us go through the process and give you feedback with what we see, because we might identify something that takes you 6 months to resolve, or you didn't even know was an issue, and it is. I'm trying to think of some things like, let's say somebody was on probation for something. Well, you need to be off probation before you can apply, or before you get approved. What else? You have to be a U.S. citizen. You have to, or a legal permanent resident. Trying to think of other things, or just cash flow in general. Your credit score. Let's say your credit is really, it has some issues. Well, it might take you 6-9 months to kind of clear that up. So having us give you the feedback of what the issues might be could give you that time. And so applying and getting pre-qualified, or at least giving the feedback now, I think is really smart to do.
Agreed. And I think that data, having that information is key, right? Whether it's the information you wanted to hear or the information you needed to hear, right?
Yeah, and then then you know, then you have the information, and you can make good decisions in the future. And just to touch on, you might have contacts at other CDCs in other states. If you do need some ideas of other CDCs, TMC can give you some names of other CDCs too.
100%. No, I value the relationship we're building here. I want it to be a long-standing relationship as well. I love what you guys are doing there. I love the transparency. Everyone that I've spoken with from the team all the way down to actually the end user has had nothing but great things to say about TMC.
Well, that's great to hear.
So no, that's legitimate for real. Let's see here. I don't want to keep you, but I wanted to, I guess, talk about, because you've oh my gosh, you've been in the industry for how long? Over how many years? What was that number?
Yeah, gosh, I'd have to do the math, but 25-ish probably. 25
years, and at least I remember hearing 3 to 4 banks, and obviously you were TMC for a reason. What are some of, let's say, because horror stories, right? What's maybe something that we don't always hear, right? Any scenarios where it looked like a great deal, looked like a great opportunity, and then maybe for lack of preparation or lack of due diligence, maybe on the end user's part, that it didn't come to fruition, and maybe some of those things that we can talk about there. And then obviously in terms of something on the opposite side, I'd love to hear some outstanding success stories where we were able to, save something that could have gone horribly wrong too, right? And yeah, I'd just love to hear from someone from you who has so much experience.
Yeah. So on the horrible side, the thing that comes to my mind, the horrible side is I sometimes read in the papers of a business that gets shut down because the landlord kicked them out and didn't renew the lease. And I see it a lot in San Francisco where prices are getting expensive, and the landlord wants to put in housing or put in some other
they're changing
business use there.
Yeah.
And so then let's say that restaurant that's been there for 100 years has to shut down because they're getting moving on. And so yes, individual deals have horror stories. I mean, there are times where you get to the end hour and you find out something that's unknown and the deal blows up. It's rare, really. It's uncommon, but it does happen. And there are horror stories. But to me, the bigger horror story are those businesses that didn't take advantage of the program and didn't fix their occupancy cost and have to shut down the business. On the positive side, though, it's the best thing about this job is working with such a wide variety of business owners. And big loans are great. We have clients that buy 10, 12, $13 million buildings and have 3 different SBA loans outstanding. They have like $12, $13 million of SBA loans outstanding. These are really big businesses that are doing well, and it's kind of fun to work on some of those big businesses. But the impact to the smaller businesses is really where you get so much. Your heart just kind of warms because you're making such a big impact on their business and all of their employees. And it might make, let's just say it's $1 million purchase. And for California, that's on the low side. But the impact to those businesses and to see the relief or the joy when they get their building, that's the success story to me.
I hear that. I even go back and kind of, I check on them, right? Whether it be a Google search or get a chance to reach out.
Or you drive into your hometown and you go, I did that building. It's fun. And at TMC, we try to support our clients. And so we have a list of all the clients we've helped, and we try to go to our communities and use those businesses. It's a fun industry to be in.
No, I wholeheartedly agree. And you get a chance to see what you see your impact immediately. Like you said, the job creation. I mean, and in the market that we're in right now, I mean, the jobs that are being created, right? That's one thing, but just to have the options. But I love the idea of creating more opportunity. Even with stepping stones, because sometimes a lot of our clients, they may not be able to qualify for SBA, so we're helping them graduate.
Absolutely.
To that opportunity, and to know that at the end of that opportunity that they're going to be able to, not only achieve it, throughout the way, but at the end there's a pinnacle, right, where you can own your building, you can be your own landlord, right?
That is the thing. You're right. The 504 is kind of the pinnacle of the SBA lending, but you start off with micro lending, and then you get to maybe a community advantage loan, and then you get to maybe a 7A loan. And there's kind of steps. I mean, you don't have to go through individual steps, right. But the 504 is kind of like to me, the end goal. Like, hey, I got it. I got my business going. I got my building now, and
Now let's talk to that a little bit, right? Just because, I mean, at the end of the day, right, that building is an asset. It is real estate. It has its own value, and now that's a part of their portfolio and a part of their
net
business.
worth.
It's a part of their valuation now.
It's again, I'm California, and I know this happens in other states, but the wealth that I've seen in just let's say the last 10 years of being at TMC, the increase of equity that these business owners have now. They bought their $1 million building, put their $100,000 down, was in there. Those buildings are $3 million now. I mean, they really have gone up so much. I mean, and even if they only go up to $1.5 million or 2 million, that's their money. That's theirs forever. So
exactly.
And they could sell the business, or they could close the business, but they get to keep that building
at the end of the day. And that and a program that allows you to be able to create assets. I mean, right, you have a lot of programs that'll dangle the debt right in front of you, but this is a true asset building program. And that's what I wanted my people to understand the most about it. This is a program that you want to qualify for. This is the program that you want to graduate to. And it's a long tail, right? We're talking about 25, 30 years. We're talking about
but you don't have to
realistic interest rate, right? Reasonable interest rates, and long term. And you also get the strategies, right? You also get the consultation to go along with you. It's not like you guys are once we fund the loan, we can no longer communicate, right? You'll help us with servicing it. You'll help us with maneuvering in and out of it as well. So you get a long-term partner to go along with it as well.
Yep, TMC, we service all of our own loans. And so as long as you have your SBA loan with us, you deal only with us for questions or any type of servicing needs that you have on the loan.
So last question, my people would kill me if I didn't ask, just because, like I say, with being CreditHub, right? You know, they're all into what how to prepare, right? We want to gain knowledge so that we can one day be here. So, and I guess in closing, if we were to identify maybe some of the key traits, right? We would identify and say we would absolutely not want to have any credit challenges. We're looking at what, 680s, 700s and above.
I mean, yeah, that's ideal. We actually don't use FICO. I mean, we pull a credit report, we see it, but we actually just look at the delinquencies and kind of understand, are there still outstanding collection accounts? Are there still outstanding past due amounts? So that's where we focus more on the credit. And if somebody has a 550 FICO score, then they're going to have a whole bunch of those types of things. So yeah,
look at the trend, but not really credit score driven, more behavior driven, right? Looking at the
behavior vision, yeah, and then also again, it's the cash flow. Cash flow is number one. So we add back the rent. So if they've been paying $2,000 a month in rent for the last 5 years, well, we add, and they're going to move from their rented building to this new owner-occupied building, then we add that $2,000 back into their cash flow. So,
wow. So if they're already in it, it's actually better if they've already kind of been leasing owner-occupied or just been a tenant. So how far back can you go? As far as, so if they've been there for years, the
vast majority of our clients have been renting for 5-10 years.
Right, forever, right? They never thought to buy.
And they're just like, I never found a building, never thought I could buy a building. I thought I had to have 30% to put down. It just wasn't in my, and then when they learn that it's only 10% down and that their new mortgage payment is going to be probably about where their rent payment has been. And for 10% down, I can just turn my rent payment into a mortgage payment. It's eye-opening. But we do, almost all of our transactions or clients have been renting for the last 3, 5, 10 years. We don't do very many startups. Startups are hard for us to get qualified for. So it's really more businesses that have a track record and been renting somewhere.
That makes sense. Now, does it matter if the applicant is a homeowner or not? Or so it doesn't matter if they're a homeowner, guys. You hear that? And
I would say the majority are. But there's no, we don't put a lien on a home. We don't really.
Right. It's always that collateral piece, right? And that's the differentiator. Can you explain that differentiation? Why collateral isn't always the end all in the 504?
Well, in the 504, we just look at the building as our main source of collateral. And the SBA is okay with 90% on just that building. There are other programs that the 7A program will oftentimes put a lien on a house. They're doing a little bit more risky deals, and to make them more comfortable, they often have to do a lien on the house. But the 504 program doesn't do that. So
yeah, it's a great vehicle. So you hear it here, guys. So score isn't the most important, but definitely there. Cash flow is probably at the pinnacle of where you want to be. Collateral, you're actually going to be acquiring the collateral in the purchase. So there you go, and equity, hopefully at the end, at the beginning, or at the buy, right?
Yes, there you go.
Have that as well. So thank you so much, Kurt, for helping us understand 504 a little bit more. And I hope to have more conversations with you. And like I said, guys, I want to get you some best practices to you. So we'll have that to you guys in a free, some free information for you guys at the end of the segment.
Well, very nice talking to you, Benjie, and happy to do it again anytime.
Thank you so much.
Okay.